Hello, this is Efrem Hoffman broadcasting live from NakedSwanTrading.com on May the 3rd, 2012 at 1:54 p.m. Eastern Time. What you're seeing on the screen right now is a high-definition risk map, a proprietary software technology developed over a 16-year period that accounts for both price and volatility movement simultaneously. And what it does is it maps out the future direction of support and resistance. Now, what's really unique about the methodology is that the support and resistance levels that we map out are hidden levels that sometimes may coincide by happenstance to critical support resistance that other technical traders look at. But the real difference is that because these are hidden points, we don't actually assume that pivot points that other people look at are always going to be relevant. They're only going to be relevant at discrete pressure points in the future, and we have mapped them out in terms of the precise locations in time and price. Unlike other cycle theories, and this is not a cycle theory, this is a mathematical physics framework, which basically means that the intelligence that we're presenting here today is not built based on trying to find recurrent patterns in historical data. It's not a rear view looking model, and it's actually not a model at all. A model tries to fit, it tries to go back to history and try to find patterns and then try to match them into the future, and the closer you can match them, then that would be a sign of a signal in a modeling technique. But that would be a little bit backward looking, because the future never replicates quite the same way. And even the patterns themselves that people actually see in the past evolve to new and higher states because more people actually take notice of them. So to get around, to circumvent or get around that kind of backward thinking, what we have created here at NakedSwanTrading.com is basically a platform that allows us to analyze the forward-looking zero momentum balance points of traders across all different timescales, going right from the tick level that algo bots would look at all the way out to multi-generational traders such as Warren Buffett. And actually even further back in time than maybe Warren Buffett would even look at a data series. We even go back in time to where the commodity markets originally started several hundred years ago, and where other stock markets in Europe have started to give us insight into what the broad structures are in the future. Now, what is key over here today is that we have a very ominous situation developing in the S&P 500, the NASDAQ, and the Dow futures. The chart that you see in front of you right now, I'm going to start with the S&P 500 E-mini. This is a 100-minute bar chart or candlestick chart, which basically means that you could see in real time over here that these black bars are candles, and the blue bars are candles that are up bars, black bars are down bars. And pretty much over the past number of days at NakedSwanTrading.com, we have put out several alerts as to the crisis in Spain, as to the developing bear market situation, and these calls were made many days and weeks in advance. But as we approach those key dates, of which May 2nd, May 3rd, and May 7th were some critical ones that were laid out in the past, then we try to hone in on a more focused range view of what's going to happen in the near term, so we could give you precise hidden support and resistance levels. Okay? And another thing I'd like to add about these zero momentum balance points before I actually give you the precise levels where volatility will attack the market is that unlike moving average, convergence, divergence technical indicators like MACD or any kind of momentum indicator. I don't care if it's a momentum indicator of price or a momentum indicator of fundamental information like price earnings ratios or other fundamental information. The key thing is, in order to measure the change in price over time as a momentum indicator, usual indicators will look at the short term and compare it to how fast price is moving over a longer period of time. And the difference will give them an idea of how quickly the velocity of price is moving at any given point in time. That represents the momentum. The problem with momentum indicators is that they end on the current bar. They don't actually tell you what the momentum is going to be at a future point in time. And if they do tell you that, then it will tend to be a prediction based on past records of information, which is, again, backward looking. What this map does is it creates a calibration of what other traders on different time frames will actually see on their momentum indicators in the future, even though those momentum indicators have yet to print out their readings. They can't print out their readings until new price values arrive in the future. But we don't require those price values to arrive in the future. We could just look at the present and know the exact calibration where their meters across different time scales will actually register zero at a precise price level. So, for example, each one of these lines that you see on the screen here represent a different time horizon. The longer the line is in the future, it means it's coming from a longer term time horizon, and the shorter, it's coming from a shorter term. And those small little ones that are moving very, very quickly are high frequency traders, okay, and very short distance boundaries. Now, the key thing to remember is that since each one of these lines, and I'll just focus on one of them to explain it. Let's just talk about this navy line. Well, as I said, if price in the future was to touch this line, now on the 9th it happens to be at 1376.75, but if you go further into the future, like into the 17th, it rises. So it basically means that traders' perceptions of what zero momentum is going to be on their MACD indicators at those future price points is going to be at different price levels. So unlike cycle fitting theories that may be able to tell you when price is likely to turn, like the key turning dates, they aren't going to identify the demographics of decision makers and traders across all the different time horizons that will provide you with insight where their indicators are going to actually register changes. Why is that important? Because if you know how decision makers are going to be perceiving changes in the future, rational people will act on that information. And since momentum indicators like MACD and RSI are one of the key types of indicators that are used by a lot of technical traders, then it makes sense that a great number of those technical traders will be acting around those key transition points. It is well known that momentum indicators are extremely good at sensing changes in major trend direction when you switch from positive to negative momentum readings on MACD indicators. But they are not as good at sensing very sharp changes, and especially abrupt volatility changes, at extremes in momentum, be it on the upside or downside. Now, most recently, the market has run up. As you can see over here, there was a sharp rally. We indicated those levels would actually repel the market. You could go to Naked Swan Trader on our Twitter feed or on NakedSwanTrading.com on the side panel, and it will indicate numerous expectations that the S&P would be capped in the days prior to today as the market came down around just above the 1405 area. And that is exactly what happened. The market ran up there and reversed. Now, how did we know that? We knew that because we had a confluence of boundaries that were actually sloped up. Now, why is it key to know if the boundary sloped up? Because, as I said, if the line represents zero momentum, then if no change in price was to occur, no new information was to come into the market, and prices were just to go sideways, that would mean that the distance of where we are relative to that zero momentum balance point that people will be reading on their MACD is going to be further and further under the water below the zero line on the MACD indicators that people will see, which basically means that people's perceptions of zero momentum as we progress further into the future are going to become more bearish even though there is no change in price. This is very similar to relativity theory in the sense that depending on your perspective and where you're positioned in time and price, or time and space, it could affect the interpretation and judgment of certain variables. And it's the same in the market. Time can bend perception of change. And knowing for each time horizon and trader type what their perception horizon will look like. And as you can see over here, we have many perception horizons that are all bending up as you pass through the 8th of May. And you can see almost everything is bent up after the 17th through the end of the month. And what that basically means is that everybody, even when no new information comes in, even when fundamental information can't explain price movement, what this is telling us is that, like dominoes, everyone will be synchronized to be seeing the same thing on their indicators, even though nothing new has transpired. So while people may think that new price has to come in and change in order to change their indicators, which ultimately will cause them to act on their perceptions, which ultimately yields a situation where you could have a liquidity problem. Because if everyone is seeing the same thing at around the same time, then it creates an imbalance in the market where you have a flood of sell orders around critical support levels that, when breached, will result in what we call a volatility attack. And right now I want to lay out those precise volatility attack points as we proceed through May. Right now, the volatility attack point that was breached earlier today, coming off the 1399.50 area, which is now going to cap the market through the 1408.50 area. So that's going to remain overhead resistance, confining market rallies, even if there's good news. Okay? Now, right now, there isn't really great news, and you can see there's a whole bunch of boundaries sloped up. So at least into May the 7th, you're going to have downward pressure in the market. Now, 1386.50 to 1388.50 is a critical attack point. And you could see, as price broke through it, and as we indicated in our Twitter feed on Naked Swan Trader earlier today, price accelerated sharply below it. Now, as you can see over here, we've got this black boundary that's sloped down. And as I said, any boundaries that are sloped up means perceptions are going to be more bearish in the future. If it's sloped down, it means more bullish in the future. But it's only more bullish up to a certain point of time. You can see this black line starts inflecting up after the 16th. You can see this blue line starts inflecting up after the 8th. So what does it mean? It means that as price comes down, there's going to be underlying hidden support that maybe other pivot points won't be able to register as you reach the black line. Now, because the black line is dynamic over time, it starts out today at a level of 1383.25, and the blue line is at 1380.92. So, and actually futures don't trade in terms of 92, so that would be 1381. So if the market was to come down to the 1382.75 to 1381 area today, you should probably be looking at your short-term time horizons, maybe like the 1-minute chart, and see if you have some divergences or buy signals. And I wouldn't suggest buying the market in a situation where other markets are actually causing prices to go lower, but you may want to take some profit in that area and then reposition on any kind of bounces back into the 1390, let's say the 1390.50, 1393 area, and definitely into that hardcore resistance at 1399.50 through 1304.50. Okay, and basically what happens here is that once we pass this inflection point, so if for whatever reason after May the 8th at 6:10 in the evening, anytime after that, if we have 100 minutes of trading taking place below 1376.75, you're going to see a very drastic volatility increase to the downside that will propel prices down to the 1361.75 area. Okay, and the reason why I say 1361.75 is because we have a confluence of these zero momentum balance points that will show up in the future on the MACD indicators of longer term traders. And when I say longer term, I mean longer term than traders looking at their MACD indicators on a 100-minute chart. Okay, the MACD indicator that corresponds to this specific time horizon is this red boundary. So any lines that project out further than the red boundary represent time horizons bigger than the 100-minute chart for which MACD would actually represent these zero momentum boundaries in the future. Now, basically, it won't be until this black line and this blue line both inflect upward that we will be able to actually get underneath this critical support area. So we have hardcore support or baseline support at 1350.50, and at the high end it's around 1361.75. So that is your risk going into around the 17th or 18th of May. But the real danger is after 4:10 in the morning on May the 18th, and I stress that, even if there does exist cycle models that could tell you about such a date, and I'm not so sure that they would know about that hidden date, but if they do, they're not going to be able to tell you the precise price point and the precise magnitude and volatility shift that would occur around those points. And they certainly wouldn't be calibrated around all of the time horizons of what traders would perceive at each point in the future. So that's why we call this a high definition risk map. It really hones down into the micro level. In mathematics and physics, this type of analysis falls into the category well beyond behavioral finance, even though it accounts for behavioral finance theory and bounded rationality, and you could read up on that on the internet. It's basically the idea that people make decisions not based on what necessarily is going to be optimal for them by looking at all available information. They look at the information that is readily available and easily available to them at the time, and based on their past experience with what worked for them. And when they combine that intelligence together, they make a very intuitive kind of judgment on what their future expectation of the future will be, and then they act on it. That's what bounded rationality is. We go beyond that because we're actually breaking down the ecology of market traders into what they are actually going to be perceiving in terms of changes in momentum of price movement, as well as momentum of volatility movement, which is a higher order variable, and changes before price. It allows us to sense change that will occur just at the cusp between a parabolic move and when it's about to fall to the ground. And like I said, because these boundaries change their shape, even if no new information was to come in and cause people to change their behaviors, that allows us to actually get in right at the peak while the market is rallying into a parabolic move at our confined boundary areas, so that we don't have to wait for any kind of moving averages or other kind of technical indicators which are price lagging indicators. This is not just an indicator that takes the lag and removes it and takes the lag to zero, but it's an indicator that has a negative lag, because it actually says something about the calibration of momentum to each precise price point in the future across all time horizons. And when you got a confluence of those horizons around discrete points in price, and it makes no difference whether they happen to be by happenstance at pivot lines or not that other people could see. It just means that those are the times where those pivot points are going to work, as opposed to more likely not working. And it could keep you out of trouble in markets that are range bound and chopping away at potential profits. It also allows you to know when to stay out of the market so you could spend time doing other things. So basically, what I'm trying to say here is that a real crisis could develop in this market if we get a close. Forget about a close. If we just trade underneath at any time during a 24-hour period, trade underneath 1350.50 on the S&P, and especially, as I indicated here, when these lines become zonal, so after, let's say, 4:10 in the morning on May the 18th, you get underneath there especially, you are going to have a catastrophic drop. Now, I kind of overuse the term, so when I say catastrophic, I'm really referring to a volatility attack that could lead to a flash crash in the market. It doesn't mean we have to go as low as the last flash crash, but it means that there's going to be a number of high-risk equities, which we have outlined in Naked Swan Trader, and there's about 200 additional equities that we have scanned across 10,000 equities around the global universe that are likely to fall over 50% as we progress through May of next year. Now, I don't believe this is going to be the only volatility attack of the year. I do believe that, this attack, when it takes place, could pull the market, down quite a bit. Potentially, if there's a flash crash, it could initially pull it down 300 points. But I'll go into more details in the next chart we'll look at. And when I say 300 points, I'm talking about 300 points on the Dow. The next level of support on the S&P would be the 1320 to 1330 area. It's not a buy signal there. It's an area where you may want to take profit. But the nice thing about this methodology is that whenever we break a critical level, we aren't stubborn about just waiting for a target price to be reached. We obviously want a significant target with a very nice protective stop that allows us to stay in the trend for an extended period. But what's more interesting about this is that we actually have a trailing stop line which corresponds to one of the higher frequency zero momentum lines that traders cannot see in the present but will only see later in hindsight. So by having that first mover advantage of that trailing stop, it makes it a very different type of trailing stop than other systems, because other systems, the trailing stop updates as each new price prints. Our trailing stops, as each new price prints, the furthest out piece of the boundary that we're looking at adds a dynamic change. But nothing that happens in terms of price between now and the end of that boundary that we could see is going to actually change the nature of what our stop is, which is good, because you don't want a stop to be changing or moving away from you. You always want it to move with the trend. And the stop that is going to apply to this trend is basically going to be the upper purple boundary. Right now, the upper purple boundary is sitting at 1407.75 to 1408. But as price starts to come down, just like you can see here, as price came down, some of the shorter term boundaries have started turning down. What's going to happen is when we are in this date period and price starts moving down, this boundary is going to be somewhere down here, and then our stop is going to be confined to the 1377 to 1385 area, okay, as we descend below 1350.50. And it's going to be this red boundary and this black boundary that's going to confine price. Once this purple boundary gets underneath this boundary, and we will have updated videos to demonstrate that when that occurs after the 18th, then this purple boundary will then be the trailing stop, and that will allow us to keep the stop at very tight levels and then even bring the stop down to 1355 so that we could have a very, very small amount of open position risk as we let the trade play out through the end of May and possibly beyond. What is actually going to indicate that there's going to be a buy signal developing in this market? What we require is that once price gets underneath this critical support area of 1350.50, then we're basically going to need a situation where we're not going to make a low until this navy boundary comes all the way down and inflects, and then comes all the way back up, and then comes all the way back down. That takes a considerable period of time. That won't be at least well into June, and we'll have to see what it looks like at that time. And if there's a setup, we'll notify you on Naked Swan Trader, and you can just look at our Twitter feed or nakedswantrading.com, and that will identify the precise area where a buy signal can develop. But that's going to be at substantially lower prices, and again, it's going to be at levels where we're trying to actually indicate a buy signal when there is a parabolic move or capitulation to the downside, in the same way that the market went vertical to the upside. We're going to try to catch, even though it's been said that you can't catch a falling knife, that is true if you're using a cycle theory, because cycle theory may tell you the right time, but it won't tell you the extension in volatility that could take place and harm you, because it's the illiquidity condition that could develop in the market that causes that final capitulation or final up spike to be much, much larger, even if you get the approximate time correct. So we're about not just getting the time correct of where the broad-based trends will turn, but also getting the precise extremes mapped out. And the only way you could actually map those out is if you could actually see or get into the mindset of what other traders are going to be interpreting across all time horizons at once. And by getting this 360-degree view, using this quantum decision-making technology, you are actually able to elevate your decision-making to a forward-looking basis. Okay? So right now, I would like to now go to a different chart. I'm going to now go to a chart, basically the E-mini 89-minute chart right now. Okay? And basically, it's basically laying out the same kind of points. A little bit easier to see on this chart because I kind of removed some of the higher frequency components just to show the broader base trend. But you can see again it's showing, on this map somewhere after the 15th where these boundary conditions start sloping up, which basically means that, between 1360 and 1349.50 is going to be the area of support. Okay, going into that period. 1415.75 is the extreme longer term resistance in the market. It's not something that is going to be challenged at this point, even if we get a rally off of these downward sloping boundaries, which are maybe offering some support, but then the support disappears, as I indicated, after the 15th. You're still going to be confined by this purple boundary, which is around the 1408 area, which is similar to what we indicated in the 100-minute chart. This is an 89-minute chart, slightly shorter time frames. But because boundaries that are larger than the red line represent longer-term boundaries than the 89-minute chart, we could still see the dimensions that overlap with the analysis of the 100-minute chart I just previously showed you. Okay? And basically, you could see here that the black boundary starts inflecting again after the 18th. So that's going to offer basically extreme institutional selling from that area all the way down. So you're going to have pretty much 14 time horizons, right down from the short-term time horizon into upper to the daily chart, indicating strong downward momentum when you break through those critical areas. The 1381 to 1375 area is a critical area that, as I indicated before, will take you down to that 1360 to 1349.50. You breach that, and then basically you're going to have an all-out volatility tack in this market going into the end of May and the early part of June at least. Okay. Now I would like to take you to a chart of the Dow Jones. This is basically, I marked this up quite a bit, so I'm just going to try to take you through this. You can see this is a 21-minute chart. And you can see we had that rally up this morning, okay, right into a boundary that is sloped up. So, and we indicated a while back on our Twitter feed on Naked Swan Trader that there would be critical resistance into near these zones over here. And basically after 1:57 a.m. to 10:21 a.m. on May the 4th, or as early as 2:30 p.m. or 6:30 p.m. on Thursday, May the 3rd, which is basically today, we have a situation where risk is likely going to increase. And that basically means that anybody that actually buys this market for short-term retracements, back up into the 13,190 area or anywhere below that on any kind of retracement is actually going to be in a higher risk situation for two reasons. Number one, more traders' perceptions in the future are becoming more bearish while price is going up. So it's basically meaning that if price is higher but perceptions are more bearish, it means that there's more downside risk when the market turns the other way. Now, of course, we don't need to have a retracement because we're already in a situation where we have a lot of upward sloping lines bounding us as early as the 13,150, and you could see here that all these other boundaries are still sloped up. Unlike with the S&P, we don't have any downward sloping boundaries. So the Dow is a little bit more bearish than even the S&P. Now, even though you may see that the Dow is down 78 points today and the S&P is down 11, and usually it's a 10-to-1 ratio. So if the S&P is down 11.5, the Dow, the futures, you would think should be down like 110 points. It doesn't go like that. When you're looking at forward perceived risk in the market, you really got to look at what is ahead of you. And what's ahead of you is quite devastating in terms of downside risk. You don't actually have a boundary that is sloped down until this red boundary, which is sitting at a level of around 12,816 to 12,801. Okay, and basically it's kind of has that kink down somewhere between the 8th and the 10th. After the 10th, it starts sloping up again. So you get underneath that area, which happens to be near one of those pivot points, lows that we made in April, which was also identified as a signal well in advance, and you can see that on our Twitter feed. You're going to have some serious market sell-off taking place, which is also going to be exacerbated by the fact that the S&P is also going to be breaking through critical levels as you get into the middle of the month. Okay, unless it breaks through the critical level, you're not going to go to the next level. But the fact that the risks are there, it really is a warning sign of things to come, at least in the intermediate term. Okay, we do have another one of these risk windows that are going to develop again in around December 7th through January the 13th, and that doesn't say that the risk window identifies when the move is going to end. It says when the move can begin. So risk could become exceptionally high again at that period, and that could be where we actually begin a major sell-off below 8,000 going into through next year. But let's deal with first things first, the short-term volatility. This is going to give us a sense of things to come later in the year. And then, we'll identify the best performing asset classes, sectors, and commodities, and currencies that are tied to those once the market tries to make this intermediate term bottom as we watch this unfold into the June period. Now, also, in terms of the upside, you can see here we've got extreme cap in the market, even in the long term, to 13,332 to 13,343, and this current rally in the market, which took us above 13,000, well above 30,200, for an extra 100 and some odd points of potential gain, which would be very, very choppy gain over an extended period of time. So you're taking a lot of risk exposure, for waiting such a long period, as opposed to, and really even all year, getting above 13,600 to an extreme of 13,800 is not a lot of upside, given the fact that the downside risks are several thousand points below where the market is. Okay, But first things first, given that the signals have triggered and the setups are here for downside risk going into June, we don't really have to worry about the 13,600 or 13,800 for short sellers. The 13,279 and the 13,191 and the 13,332 are going to be intense selling pressure areas. And as you move further into May, those areas are going to drop down to below 13,100 and then rapidly come down as we push into that 12,800 area. Okay, so this is a very precarious situation, and we'll have to monitor this situation very, very carefully. Now I would like to take you to the NASDAQ market futures, and what you can see over here is a high-definition risk map of the NASDAQ futures, and the risk map is overlaid on a 34-minute chart. And as I indicated before, the time horizon that corresponds to the 34-minute chart is this red boundary. So any boundaries longer than that represent time horizons longer than that in terms of how people would register zero momentum. So if price was to, let's say, land on this red boundary of this longer-term time horizon, it basically means that their momentum indicator, the MACD indicator, I only put MACD on here. I labeled it as jerk X. Jerk basically represents the rate of change of acceleration of an indicator, so that's why I labeled it like that. I don't actually use any of these indicators. They're just on here to show you the limitations of those indicators. These indicators are not bounded in terms of price. What it means is that over here, basically, you could be at a more extreme level in momentum than over here, but yet price could be at a lower level. So there is no relationship between calibrating price and momentum to specific levels. Whereas with these boundaries, not only do they not end at the current price bar, but because they're forward-looking, they also are able to calibrate the specific price level where this momentum indicator in the future will represent zero. Now this momentum indicator happens to correspond to the 34-minute chart, which relates to this red boundary. But for longer term time horizons, then, and that are scaled at periodic higher scales of traders, so it would mean that traders that trade on a longer term basis will be looking at their momentum indicator. But instead of being on a 34-minute chart, this may represent a 200-minute chart. This may represent a 400-minute chart, and so on. So, and if you look at all the boundaries going from the very smallest to a boundary that covers the entire market since it actually started existence over, several decades ago in terms of the S&P, or over 100 years ago in terms of the Dow, whatever market we happen to look at, it gives us an idea of what everyone is seeing at the same time. And as opposed to just some traders that may be looking at a time frame that they're comfortable with. That may work for a period, but when you get into critical transition points in the market, those kind of situations break down, and the indicators could fail for extended periods, and that's when they could kind of go into drawdown. So it's also very critical to have some kind of market map that identifies state changes that will actually help traders know when certain kind of trend following systems or fade reversal systems will work best. Obviously, fade reversal systems are going to work best in situations where you're spiking into one of these upward sloping lines that indicates perceptions in the future are more bearish, because that's going to cause more traders immediately after that point to start pushing prices down. Now, for trend followers, it would be very useful to them that when you break critical areas, like over here, for example, 2703.55, if we get underneath there for more than 34 minutes, especially after the 4th, then basically you're going to be capped at a level of around 2719, and the lower end would be about 2710. And then basically there's going to be a little bit of, a slight amount of support between 2689.50 and 2697 going into the 6th to 8th. And this is not an area to buy. This just means maybe look at your short-term 1-minute chart and see if there's any divergences. And if there is, you may want to take some profit around that area. But if there isn't and price keeps on coming down and we happen to get past the period of May 8th at around 7:20 in the evening, or even 6:50 in the evening, and we get underneath 26.96.90, if price happens to be under there for more than 34 minutes at any time after May the 8th at 6:50 p.m., then basically all other boundaries below us are all sloped up and vertical, and all boundaries above us are sloped up, which basically means you're going to have a huge volatility attack to the downside. And because there's such a big distance between these boundaries, you could almost think of them like orbital levels inside of an atom, where it gaps, where an electron gaps from one level to the other without spending too much time anywhere in between. Okay? And because there are no boundaries that are sloped down that are supporting the market between this critical level of 26.96.90 and the next level of 26.46 to 26.35, there's going to be a very sharp burst of volatility there. Now, the ominous thing is that if we get below this level of 26.34.75 to 26.35.60 and stay underneath there for more than 35 minutes at any time after, especially after May the 9th at 10:10 in the evening, then you're going to have a situation where you're going to have a volatility attack to the downside that will be enormous relative to anything we've seen for quite some time. And that could take the NASDAQ down another 100 points. But we'll monitor that, and as it unfolds, we'll indicate on a trend piece on NakedSwanTrader.com and Naked Swan Trader exactly how the stop line will come down and allow you to stay in the trade as long as you can before we identify specific sectors that are going to outperform on the next short-term retracement before the next volatility bursts down. Again, the NASDAQ market will be impacted by the fact that the S&P and the Dow are also in a bearish mode situation. And as we all know, when you have more than one market acting in the same way, then, as well as traders on several different time horizons that have been concentrated into trades that may have been overcrowded at critical levels to the upside, and then prices flip around the other way, on top of the fact that our boundaries are saying that they're going to perceive even more bearish activity. So sentiment readings that other people look at will start indicating that what we're actually seeing, except because we're actually seeing that before they're going to register it on their meters, it gives us a heads up of what's going to take place. So that pretty much sums up our analysis of the NASDAQ, S&P, and Dow futures going through the June period. And I welcome all of you, especially new listeners, to come to our website at Naked Swan NakedSwanTrading.com, as well as our Twitter feed at Naked Swan Trader, and listen for updated forecasts and additional market alerts. And we just don't focus on downside alerts, but also upside alerts when it is ready. One last thing I'd like to mention is that we also put a note out yesterday, very interesting piece yesterday and the day before, one on regarding the Spain crisis. It's on our website, okay, under video alerts, and another on the euro-dollar crisis that is about to hit the LIBOR market and interest rate derivatives that could really put a tailspin in the overall equity markets and hurt the situation overseas as some assets get repatriated. Also, there was also an alert out on Exxon Mobil, one of the Dow components, one of the largest Dow components, that it's in a very, very critical risk window and breaking down hard to the downside. And basically, that is going to actually, because it's a large market cap weighting also in the S&P, or significant weighting anyways, that could, and the fact that it's tied to many market sectors and different types of indices, it could put it could be the canary in the coal mine that offers a pilot light indicator of things to come in the overall market. We also put an alert out on ISRG that it's a component that's rolling over, and it did, as well as we were one of the first, or probably the first, way back over a month ago, to indicate the sell-off in Apple shares as the market was making new highs. We identified the peak of that parabolic reversal in advance as it was pushing up into key hidden resistance boundaries, and the market reversed sharply. I believe you could see that post also in our Twitter feed on Naked Swan Trader, and on our website under video alerts, which was issued on March the 30th. There was also a number of warnings prior saying that it was getting overvalued. Okay, so anyways, right now I look forward to updating you as this market storm unfolds. Thank you.